Hey everybody! Today we're diving deep into one of the simplest yet most effective strategies out there, buy and hold forever. Specifically, we'll be talking about Vanguard ETFs. So grab your coffee, tea, or whatever you prefer to sip on while we talk about investing, and let's get into it. Alright, let's kick things off with a real heavy hitter in the ETF world, the Vanguard Total Stock Market ETF or VTI. This bad boy is like the ultimate all-in-one package for your portfolio. Remember when I talked about diversification being key? Well, VTI takes it to a whole new level. We're talking about holding almost every publicly traded US company in one single ETF. That's right, you get large-cap companies like Apple and Amazon, mid-cap companies that are on the rise, and even small-cap companies with explosive growth potential. It's like owning a tiny slice of the entire US stock market. Think about it, trying to pick individual winners in each of those categories can be a full-time job. Not to mention incredibly risky. With VTI, you don't have to. You're automatically invested in the entire market, riding the wave of overall economic growth. And the best part? The expense ratio on VTI is incredibly low, currently sitting at a minuscule 0.03%. That means for every $10,000 you invest, you're only paying $3 in fees per year. Talk about practically free. This low-cost approach is essential for long-term investors because it allows more of your money to compound and grow over time. VTI is like the bedrock of a solid, buy-and-hold forever portfolio. It's diversified, it's low-cost, and it gives you exposure to the growth potential of the entire US stock market. If you're looking for a single ETF to build your portfolio around, VTI is an incredibly strong contender. It's like the ultimate set-it-and-forget-it investment. You buy it, you hold it, and you let the magic of compounding do its work over time. But hey, I know some of you might be thinking I want to focus on the biggest and most established companies in the US market. Well, don't worry, I've got you covered. Let's move on to the next ETF on our list, which focuses specifically on those big players. Now let's talk about another powerhouse in the ETF space, the Vanguard S&P 500 ETF, or VOO for short. This ETF tracks the S&P 500 index, which comprises 500 of the largest publicly traded US companies. We're talking about household names like Apple, Microsoft, Amazon, Google, you name it. These are the companies that have a proven track record of growth and stability, making them the backbone of the US economy. Investing in VOO is like investing in the collective success of these corporate giants. And historically speaking, the S&P 500 has delivered impressive returns over the long run. Now I know what you're thinking. Isn't VO less diversified than VTI since it only holds 500 companies compared to VTI's thousands? And you're right, it is. But here's the thing. The companies in the S&P 500 are so massive and influential that they represent a significant portion of the total US stock market capitalization anyway. So, while you might not be getting exposure to every single publicly traded company like you would with VTI, you're still getting a hefty chunk of the market's overall performance. Plus, VOO boasts an incredibly low expense ratio, just like VTI, currently at 0.03%. That means more money stays in your pocket and less goes towards fees. VOO is a fantastic option for investors who want to keep things simple and focus on the largest, most established companies in the US market. It's a great choice for those seeking long-term growth potential with a bit less volatility compared to investing in smaller companies. But hold on a second, we're just getting started. What if you want to expand your horizons beyond the US market? That's where our next ETF comes in. Get ready to go global, because we're about to dive into the exciting world of international investing. Alright, so we've covered the US stock market, but what about the rest of the world? Don't worry, we're not neglecting the global market. That's where the Vanguard Total International Stock ETF, or VXUS, comes into play. This ETF gives you exposure to the entire world of international stocks, excluding the United States. We're talking about companies from developed markets like Europe, Japan, and Australia, as well as emerging markets like China, India, and Brazil. Now, you might be thinking, why bother with international stocks? Isn't the US market enough? And while the US market is undoubtedly a powerhouse, diversifying globally is crucial for several reasons. First, it reduces your reliance on any single country's economy. Remember the saying, don't put all your eggs in one basket? Well, the same applies to investing. Second, international markets can offer growth opportunities that might not be as readily available in the US. Think about it, emerging markets are often characterized by rapid economic growth and a burgeoning middle class, which can translate into significant investment potential. VXUS allows you to tap into these global opportunities without having to research and select individual international stocks. It's like having a team of experts build a diversified international portfolio for you, and they charge you a minuscule fee for the service. Speaking of fees, VXUS comes with a low expense ratio of 0.07%, which is incredibly reasonable considering the vast diversification it provides. By including VXUS alongside your US-focused ETFs, you're essentially spreading your bets across a wider range of companies and economies, which can help smooth out your overall portfolio returns over the long run. So, if you're serious about building a truly diversified buy and hold forever portfolio, adding VXUS to the mix is a smart move. It allows you to participate in the growth potential of the global economy while mitigating risk through diversification. But hey, we're not done yet. We've covered stocks, both domestic and international, but what about the other side of the investment coin? That's right, we need to talk about bonds. Alright, let's shift gears a bit and talk about an asset class that's often overlooked, but plays a crucial role in a well-balanced portfolio bonds. Specifically, let's talk about the Vanguard Total Bond Market ETF, or BND. You see, while stocks are known for their growth potential, bonds are all about stability and income. Think of them as the responsible older sibling to the stock market's wild child personality. BND invests in a diversified portfolio of U.S. investment-grade bonds, which are essentially loans issued by governments, corporations, and other entities. When you invest in BND, you're essentially lending money to these borrowers in exchange for regular interest payments, known as coupon payments, and the return of your principal when the bond matures. Now you might be thinking, bonds sound kind of boring compared to the excitement of the stock market. And you're right. They're not as glamorous as high-flying tech stocks, but they serve a vital purpose in a long-term portfolio. Bonds act as a ballast during market storms. When the stock market throws a tantrum and takes a nosedive, bonds tend to be less affected, and in some cases, they might even increase in value. This is because bonds are considered lower risk compared to stocks, so when investors get spooked by market volatility, they often flock to the relative safety of bonds. By including BND in your portfolio alongside your stock ETFs, you're essentially creating a shock absorber that can help cushion the blow during market downturns. This can make a huge difference in your overall portfolio performance over the long haul, especially if you're the type of investor who gets easily rattled by market swings. Plus, BND still provides a steady stream of income through its coupon payments, which can either be reinvested to buy more shares or used to supplement your income in retirement. So don't underestimate the power of bonds in your portfolio. They might not be the flashiest investment, but they play a vital role in mitigating risk and providing stability, especially during market turbulence. Alright, we've covered a lot of ground today, but I've saved a special ETF for last, the Vanguard Dividend Appreciation ETF, or VIG. This ETF is perfect for investors who want the best of both worlds, the growth potential of stocks and the income-generating power of dividends. VIG focuses on companies that have a proven track record of consistently increasing their dividends year after year. We're talking about companies that are financially healthy, profitable, and committed to sharing their success with their shareholders through steadily rising dividend payments. Now you might be thinking, why are dividends such a big deal? Well, dividends provide two key benefits for long-term investors. First, they act as a source of passive income. Imagine receiving a paycheck from your investments every quarter, regardless of whether the stock market is up, down, or sideways. That's the beauty of dividends. Second, dividends have the power of compounding, just like reinvesting your earnings from a savings account. When you reinvest your dividends, you're essentially buying more shares of the underlying companies, which can lead to exponential growth over time. VIG takes the guesswork out of finding companies that consistently increase their dividends. It's like having a team of dividend experts handpicking the best dividend-paying companies and bundling them into a convenient, low-cost ETF. So, if you're looking for an ETF that combines the growth potential of stocks with the income-generating capabilities of dividends, VG is an excellent option to consider. And there you have it, 5 fantastic Vanguard ETFs that are perfect for building a rock-solid buy-and-hold forever portfolio. Remember, investing doesn't have to be complicated. By choosing low-cost, diversified ETFs like these, you can set yourself up for long-term success without having to spend all day glued to your computer screen watching the market. Just remember to do your own research, determine your risk tolerance, and consider your investment goals before making any investment decisions. And as always, if you're unsure about anything, don't hesitate to reach out to a financial advisor. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips. Thanks for watching, and happy investing. Now go out there and start building that buy and hold forever portfolio. You got this.